Welcome to everyone. In this new video on interest rate risk in the banking book hedging strategies. So the video is divided in two parts. In the first part, I would like to walk you through the non-linear hedging instruments such as caps, floors and swaptions. And the second part will cover interest rate swap strategies. And the reason why it's important topic, in my view, is the current interest rate environment. In particular, you can see what's going on in the market in UK, what's going on in US, inflation in Europe, and the central banks has to take steps to overcome and to fight inflation. The rates obviously are going up. Market is on the medium-long part of the curve. Market is discounting the probably coming recession, and on the short end the rates are shooting up, literally shooting up. And this is why balance sheet managers, treasurers will need to come up with the proper hedging strategies. And one of those strategies could be taken on the interest rate options. IRRs, like call them quite often. And IRRs are the type of instruments which are belonging to the non-linear hedging instruments, because these are options. Options means that they are a binary exercise, or you exercise or you don't exercise binary outcome. So it's not like a interest rate swap when you have the constant cash flows exchange between two parties, and there is no option. If you enter into the swap, you have entered and you have to exchange the swap, the cash flows on the both legs, short floating rate and fixed rate of the swap. Here you exercise the option if something happens, or you don't exercise, then the option is out of the money and its value is zero. So you do not exercise the option and it's not there. So basically you're paying the premium of the option. Obviously you paid the premium for the option, for the acquisition of the option, but basically the option is not exercised in this situation. Now, caps, floors are the most frequent interest rate options used for the hedging of the balance sheet. And I would say especially because floors are very often used when the rates are low or when they are moving downward. Then it was the situation in the past years when we have the very low and negative rate environment, or low in UK, for example, in US, and negative in Europe. Then you have seen definitely floors being deployed as a hedging instrument to protect potential margin compression. And margin compression would occur when the rates moved theoretically below zero, and your margin would be squeezed, because obviously moving down you would get this negative impact on your NIM. If you have the floor embedded into the contractual instrument, like for example many corporates loans, which are indexed to the reference rate IRRBB or SONIA, then you see that these are subject to this floor at zero. And it was quite often the case in the past years, like I said, because this value had a lot of difference. The value of the option had made a lot of difference to the balance sheet, because having the floor was protecting your net interest income sensitivity, obviously because of the magnitude of the shock. So imagine if you have the rates minus 0.5% and you have zero floor, obviously if you shock down by minus 1%, so the shock down by 1%, so you will end up minus 1.5%. You won't see any impact in terms of your net interest income sensitivity if you have the floor, obviously, because the floor is meant to protect you, and the strike at zero definitely will be exercised at the point when the rates are moving under negative rates territory. Caps are just the opposite. So these are instruments which are meant to protect you in case rates are moving up. So you have this potential a cap or strike of the cap which is protecting you against unprecedented movement of the interest rates up. So you set up this floor, this strike, which locks in your expenses, for example, on the liability side, at the predetermined level of interest rates. So in case the rates moved further up, your loss will be mitigated through the payoff of the cap which has been acquired by the balance sheet manager. Caps are and floors. These are longer term instruments, for example 2 years, even up to 10 years. They are quite liquid in the market, and they are divided. They are comprised of caplets or floorlets. So what is the floorlet? So, for example, if your floor is referenced to IRRBB 3 months, so every 3 months you will be making a payment on or will be receiving a payment, sorry, you will be receiving, if you are a buyer of the floor, you will be receiving the payoff based on the difference between the reference rate and the strike, or the strike and reference rate, and just the opposite for the caps. So they are this shorter term part of the floor, which are now floorlets, and every floor is composed of many floorlets. The same caplets. You have caplet, which is the part of the cap instrument, and it's basically according to the frequency of payment. It could be every 6 months on semi-annual basis, or it could be on the quarterly basis. You are receiving potential payoff from the cap because you are buyer of the cap. So one thing it's very important to say, that it depends on which side you are staying, because you can be long in terms of the option. So if you are long, it means that you own the option, you acquired the option. The option is obviously your insurance, some kind of insurance, because it helps you with management of the interest rate risk if your rate move in some particular direction, which you could expect as a treasurer of the bank or as a balance sheet manager, or if not, you just don't exercise the option. So in this sense, as I said, you are long or you are short, so which means that you sold the option, and as you saw, given that you sold the option, you will be getting a premium. So if the option is in the money, then obviously you will have to pay. You will have to pay the difference between the reference rate and the strike. But in case the option is out of the money and it's in life, you will get the stream of premium in terms of the premium on the option, because if you are selling, you are getting the premium. So let's have a look how it's constructed exactly. So you can see that here we have the caps, and imagine the cap with notional of 1 million euro. Starting date of the cap is 30th of April 2021. The cap maturity is 2 years, and cap strike is 1%. Reference rate is IRRBB 6 month, and the premium is 0.1% of the notional, which is paid on semi-annual basis. So then let's analyze the every single caplets and the cash flows. So imagine that this is repricing, as here we are saying, on semi-annual basis. Then your fixing dates will be as follows. The first one will be 30th of April, the second one October, April, and so on and so forth. and then your cash flow will be, as I said, multiplied by the notional, obviously, but it will be the difference between the reference rate and the strike. So in case the reference rate is 2% at the moment of refixing, you have strike of 1%, then you have the difference of 2% minus 1%, so 1% will be your cash in, driven by the cap, so driven by entering into this kind of instrument. However, there will be this additional premium which you have to pay because you bought the option, and the seller of the option will get this premium. Then you have the second case, which is the case of the floor. The same. So we know that every single floor is composed of many floorlets, and notional amount of 1 million euro. Reference rate is EURIBOR 3 months. The strike rate is, let's suppose, 0%. Starting date of the contract is 1st of February 21. Maturity 1 year, tenor 3 months, and the premium as before 0.1%. So then you will get the same, you will get the difference between the strike and reference rate, and you will pay additionally on the top premium, because premium, as I said, is always paid to the by the option buyer to the option seller. And you see that the frequencies here, quarterly frequency, you have this exchange of the cash flows at the point of the refixing. So this is exactly the refixing date, and at the point of the refixing date you will get this cash flow from the floor, or from every single floorlet. What is important point which I wanted to highlight here, that usually caps and floors and swaptions, we will speak about swaptions quite extensively, because in my view it's very important instrument. So floors and caps are quite often called automatic options. So if you remember, the Basel Committee on Banking Supervision, they explicitly they are saying, this standards, that you have to include in your IRRBB calculations the additional on the top of the EVE calculations, economic value of equity, by every single shock. You need to include also the changes in the automatic in the value of the automatic options. And it means that practically, from the practical perspective, you need to calculate your time value and economic value of the option, and to include by scenario to the overall calculation of economic value of equity, which is quite important because it can change significantly exposure of your balance sheet. So you can change from being net asset position to being net liability position because of the options, of the value, economic value of the options. So just the opposite, from the net liability position to the net asset position. This was exactly the case which I have seen in the past in one bank. Swaptions instead are instruments which are now very important for hedging pipeline risk. So as you know probably very well, that we are having some products on the balance sheet where the origination date and the drawdown date of this fixed rate product, fixed rate asset, is different, is not the same. So, and there is these loans are sitting in the pipeline for quite long time period, for 3 months, even 4 months or 5 months, and until they are drawn down. In the situation like we are living right now, the rates are literally shooting up, which means that the the situation which you have at the point of the origination of the loan could be completely different in the moment of the drawdown of the loan in terms of the rates, which means that you could be faced to the potential margin compression. And to limit or to hedge the margin compression, which is driven by the items sitting in the pipeline, you would go with swaption. One of the options, and one which I strongly recommend, is using the swaptions for pipeline hedging. But before we go to and cover the pipeline hedging, I would like to define what is swaption. So swaption is the over-the-counter option instrument. As I said, they are belonging to the IRRBB family. The difference is that here the underlying is not the interest rate itself. It's a plain vanilla swap is the underlying asset. So basically you can enter this instrument, allow you to enter into the swap interest rate, plain vanilla interest rate swap within the predetermined time period at the predetermined rate. So you agree the rate today, and you can execute the option. As I said, you can execute, but it's not necessary. So it depends on you, on the market, basically on the market in terms that you will be driven by the market if you want to exercise or not. So obviously, if the conditions are adverse, then you won't exercise the swaption. If the conditions are with you, so in advantage, then obviously you will exercise the option, the swaption. And what does it mean exactly? So if it is the option on, you are the swaption buyer, and you will buy the receiver swaption, which means that you will be potentially exercising in the future the receiver swap. So you'll be receiving fixed rate and will be paying floating rate. Meanwhile, just the opposite, if you are buying the payer swaption, then you will enter into the payer swap within the 6 months, let's say, or 3 months. It depends on the time horizon, and you will be paying fixed and receiving floating. So what is the advantage of this instrument? The advantage is this flexibility. Flexibility in terms of the, just tailor-made instrument. Imagine that you assume that some portion of your pipeline will be drawn down, and you think that the rates, you are not sure if the rates will be moving exactly in line with the forward rate. So some portion you will hedge with the forward starting swap, but there is this additional amount which you would like hedge against rates potentially moving higher than a forward rate forecast. So what you do, you would probably enter into the swaption, and if the rates move up at the level which is higher than the forward rate, then you will exercise the option if you are going to receive the fixed rate, or if you are lower, if you are going to pay fixed rate. So it's only has to be for your advantage. You have to be in the situation when it's worth for you to execute the option. So in terms of the asset, we are talking about payer swaption, because obviously you will be entering into the swap which is hedging the fixed rate asset. So we are talking about the payer swaps. In this video, it is just very brief introduction. I want also to show you the example, and the next session will cover the linear instruments, which are swaps. And then I would like to also speak a bit about pipeline hedging, which I think at the moment is quite important topic for all treasurers of the bank, because if you don't hedge and the rates are moving higher and higher, then potentially you could face significant impact on the P&L. Let's end up with this example. We assume the bank funds itself through floating rate liability, which is indexed to EURIBOR 3 months. At the time of the analysis, the swap rate for EURIBOR 3 month with 5-year maturity is, let's imagine, 6%, and the treasurer of the bank fears the increase in the interest rates. So treasurer has an option to enter the payer swap over the 5 years period straight away, now. In this way, the bank will be hedged against interest rate increase. However, there is always uncertainty when this increase is going to happen. So the bank's treasurer may decide to buy the protection against, we said that options are protection. It is protection against rates moving up or down. In here we are in this particular example, it is the protection against interest rates increase in the near future, let's say in 6-month time period. So treasurer is buying the payer swap with the strike 6%. And in case in 6 months the swap rate is higher than 6%, the option is exercised as the underlying swap rate which you will be paying is lower than the market rate. So in the contrary, when the swap, the new conditions are lower, so the rates are lower in the new conditions, then you will obviously enter into the swap rather than exercise the swaption. So this is all for this video. Thank you very much for watching.